come in on that one. It's Samina joining in as well. With rural spending recovery, wedding season demand, how should investors now position themselves in the consumer discretionary stocks? So I want to try and get actionables from you. So people who, of course, follow you and believe in you would like to know, how do they play the space now?
So, Samina, good morning. I think we have a very clear situation here where the low ticket consumption items have seen a bit of a hammering if you go by the syndicate data about Nielsen or Kantar. And of course, it corroborates very well with the management commentaries that we heard in second quarter FY25 earnings season. So staples, some of the select discretionary stocks have had a very tepid last 3-4 quarters of volume growth. And reasons are different. The latest excuse or reason which has emerged in the quarter that has gone by is the urban slowdown or urban stagnation. Last 2 years we had seen rural slowdown in demand, which is thankfully now picking up, and monsoon has been good, right? So as far as actionables are concerned, we've been very clear for last 3 years that money will be made in consumption over a slightly longer term in discretionary stocks rather than staple stock. Because as the per capita income increases, the propensity to spend towards discretionary items go up. So what do we like there? If you look at our model portfolio, there is a broad smattering of discretionary stocks out there. So we like jewelry, within which we had Titan and Kalyan also in our model portfolio. We like Indian Hotel, which is amongst our top 5 mid-cap ideas, though I don't know if it is still a mid-cap as per SEBI classification, because the market cap is now upwards of 1 lakh crore. We like the space that you were just discussing before I joined you, which is the food delivery space, wherein we like Zomato. And then there are mid-cap discretionary stocks like Metro, Cello, where we have a very positive view. So consumer discretionary is where we would want to place our bets, and which is where our overweighting consumption is concentrated into in our model portfolio.
This market cap wise, right? Among your large cap recommendations, you've got M&M, SBI, L&T. Which do you believe offers the best near-term upside, and why?
So again, Samina, without quantifying a short-term, near-term upside, because it's very difficult and beyond anybody's reach to forecast what the stocks will do in a week or 2 weeks' time. Fact remains that M&M has been our preferred idea for 3 years now. In fact, we don't have Maruti in our model portfolio since 3 years, because we converted our entire Maruti position into M&M almost 3 years back, and just paid out pretty well. If you see M&M's underlying fundamentals, they've been as strong as ever. And now with rural recovering, I think it'll provide a leg up to their tractor business. SUVs has anyways been strong. And plus the SOTP angle of M&M, the rest of the businesses in the group, which are part of the M&M SOTP, they're also doing quite well. SBI remains our absolute favorite in PSU banks. We've almost a 4% weight for SBI in our model portfolio. 18-19% ROE, stock trading at 1.1 time, asset quality absolutely fine. Trade growth about 11-12%, or sorry, maybe 13-14% for SBI. So valuations are absolutely mouth-watering for SBI at this stage. And of course, L&T, reasonably priced in an overall, I would still reckon, an expensive space, which is industrials. The stock has done nothing, pretty much nothing for the last 1 year. But if you see, the balance sheet has improved significantly for L&T, and visibility of ROE improvement is also there. Right, so I would go ahead and say that L&T today is the most reasonably priced industrial/capital goods stock. So those are our top 3-4 bets. But to say which one will give what return in the short term is very difficult.